I'm still reading from within RESPA regarding the GFE. I made it all the way into the contents. I'm sorry, I passed the GFE. I'm no longer working on the GFE. I'm talking about settlement sheets, settlement statements. And I'm gotten to the point of the contents of those, leaving off on the top of page 257. The average charge may not be based on the loan amount or the property value. And I've just never heard of this average charge method. Use of an average charge. I discussed that at the end. And I don't think that the what's written here exactly explains what average charge is either, but it explains what to do if it's being used. Like, for instance, if it's used, it must be no more than the average amount paid by one settlement service provider to another for a particular class of RESPA-covered transactions. And the class of transactions must be defined using a type of loan, a period of time, or a geographic area. And the same charge must be used for every transaction in the class. So if you're using the average charge, it may not be based on the loan amount or the property value. Sounds like it makes it very difficult to calculate if you're using the average charge. A service provider must retain documents to support the average charge calculation for 3 years from the settlement date. Average charges, calculated by using a documented method, are allowed for third-party charges not based on the property value or the loan amount, such as appraisals, credit reports, or flood determinations. Average charges may not be used for transfer taxes, escrow and interest reserves, and interest charges. And further contents of the settlement sheet is the comparison table to the GFE disclosed costs for the same services, and it also must list the primary terms of the loan, including the rate and payment information. Exemptions from the settlement sheet is when the borrower waives his or her right to receive the settlement sheet at closing, but it must be mailed as soon as practicable. And if the borrower or the borrower's agent does not attend settlement, the HUD must be mailed as soon as practicable. A violation of this section is considered a violation of Section 4 of RESPA. However, the lender may cure an inadvertent violation by providing the HUD within 30 days after settlement. Electronic disclosures are any disclosure here under RESPA that can be provided as long as e-signed consent is received from the buyer. And that applies to the affiliated servicing disclosure, business arrangement disclosure, the servicing disclosure, servicing providers disclosure. I can't remember the exact titles of these right now. Servicing disclosure statements. It applies to the GFE. It applies to special information booklets, the affiliated business arrangement disclosure, and believe it or not, the settlement sheet. So now that we're through with e-sign applicability, fees. No fee may be charged for the completion of any RESPA or Truth in Lending Act disclosure. And part 3 is with regards to kickbacks and unearned fees. No person may give or receive a fee or anything of value in connection with any agreement or understanding that business related to a federally related mortgage will be referred to any person things of value, including payments, advances, funds, loans, services, or other consideration, including salaries, commissions, fees, duplicative payments of a charge, free rates, special prices, reduction of an existing obligation, discount, stock, preferred treatment, and so forth. So no person may offer things of value related to a federally related mortgage loan. I mean, that's so vague that it's almost meaningless. Reading on here, because parts of the kickback and unearned fees are actually important. The payment of a referral fee or kickback may not be direct or indirect. An agreement or understanding does not have to be written or verbalized, but may be established by a pattern of practice. And the fact that a payment of value does not increase the charge of the service to the borrower is irrelevant when determining whether a violation of RESPA has occurred. Furthermore, the payment for services should bear a reasonable relationship to the value of goods or services. To the extent that the payment exceeds the reasonable value, it may be considered to be a kickback or referral fee. So the second point under kickbacks or unearned fees is that no person may give or receive a portion of a fee for services connected with a federally related mortgage except for services actually performed. The following practices are considered illegal. That's A, B, and C. A, two or more persons splitting a fee for settlement services where all or part of the fee is unearned. B, one settlement service provider marking up the cost of the service without providing any actual service to justify the additional cost. And C, one settlement provider charging the customer a fee where no nominal or duplicative work is done or the fee is in excess of the reasonable value of the service. To explain, under Akirva versus Chicago Title and Trust Company and other cases, this rule is modified in a number of states. If a consumer is charged more than the actual cost of settlement service provided by a third party, it is not illegal in Indiana, Illinois, and Wisconsin, provided the third party is not involved in the markup. The anti-kickback prohibition does not prohibit payments to attorneys for services actually rendered or to a title company for services performed in issuing a policy, to an agent of a lender for services performed in making a loan, between cooperative real estate agents and brokers, to any person or services actually performed, or for normal promotional and educational activities not conditioned on the referral of business and an employer's payment to its own employees for any referral activities. That's where it makes it very difficult to really understand what is being referred to here. Because you understand there can't be any kickbacks and there can't be any unearned fees, but part one is that anything of value can't be, given to anyone else related to a federally related mortgage, which is just so vague, it's outrageous. And then we go into two, which actually lists things being illegal, which is two people splitting a service fee where some of it is unearned, or marking something up extensively, or charging a duplicative fee or a fee for work that didn't have to be performed, and then saying that in certain states that's not the case, and then saying third that it does not prohibit these things, which is involving attorneys, title, agents for the lender, like the loan originator, real estate agents or brokers, or any person for services actually performed, and educational activities, and then referrals. So what exactly is it referring to? It's very hard to pinpoint. Referrals are discussed a little further. A referral just includes any oral or written action directed to a person that has the effect of affirmatively influencing the selection by the person of the provider of a settlement service. And referral also occurs if the lender requires the borrower to use a particular provider of settlement service when the borrower will pay for the service. The lender payments to mortgage brokers is addressed in a policy statement by HUD stating that lender payments to mortgage brokers are not illegal if, when analyzed as a whole, the payment is for goods or services actually furnished and the payment is reasonably related to the value of the goods or services furnished. Yield spread premiums. Before I go into yield spread premiums, I think I'll discuss this as an example, being that a credit report costs $20 and yet was quoted on the GFE as $30. And in many cases it is $30, but in the occasional case you have it costing less. And then $10 is being charged for a credit report that only costs $20. So it's being marked up by $10. Is that illegal? And I'm going to run through this a little bit. 2, no person may give or receive a portion of a fee for services connected with a federally related mortgage except for services actually performed. And the following practices are considered illegal, which is one settlement service provider marking up the cost of the service without providing any actual service to justify the additional cost. Does that refer to the credit report? Because the service is actually performed. I mean, no person may give or receive a portion of a fee for services connected with a federally related mortgage except for services actually performed. And then you move down here to B, one settlement service provider marking up the cost of the service without providing any actual service to justify the additional cost. It's really just hard to say given the expression of this section. I'm going to probably go back to the actual regulation. It appears to be under section 1024.14 and read it. 1024.12 is about your fees for disclosures, and then 1024.14 is about your kickbacks and unearned fees. Gonna have to just read it directly from the reg because it's just confusing the way they're presenting it here. Before we get into title companies and service requirements, there's still a couple more things to be said under kickbacks and unearned fees. And if my computer ever cooperates with me, I'll be able to get to it. Right. So we're saying that yield spread premiums, where we left off on page 258, are subject to the test for payments to brokers, and higher interest rates alone cannot justify higher total fees to mortgage brokers. The borrower must be charged a lower upfront cash payment I'm sorry. B under yield spread premium says higher interest rates alone cannot justify higher total fees to mortgage brokers. The borrower must be charged a lower upfront cash payment. Broker fees, including yield spread premiums, must be disclosed to the consumer using clearly understood terms that describe the services provided by the broker, the total compensation paid to the broker, whether the broker has an agency or fiduciary relationship with the borrower, and the fact that the borrower may pay higher upfront costs for a mortgage with a lower interest rate, and identify the trade-off between the amount of increase in payment and the amount of upfront payment. Lastly, broker fees may be disclosed on the GFE HUD on separately or separately on another document. So these things have to be disclosed to the borrower. The services provided by the broker, the total compensation paid to the broker, and whether there's an agency or fiduciary relationship, and the fact that higher upfront costs for a mortgage with a lower interest rate is a trade-off between the amount of increase in payment and the amount of the upfront payment, which is going to make perfect sense to them. Another item under the HUD is that HUD issued a statement of policy on sham-controlled business arrangements. The use of a shell entity or sham arrangement for the provision of settlement services is not authorized by RESPA. A settlement provider that is an affiliated business arrangement must be a bona fide provider of settlement services. Factors that are assessed to determine whether an arrangement involves a bona fide service provider are like the following 8 questions. Does the entity have sufficient capital and net worth typical in the industry? 2, is the entity staffed with its own employees? 3, does the entity manage its own business affairs? 4, does the entity have an office or business that is separate from one of the parent providers? If it is located in the same place as the offices of one of its parents, does it pay market value for the facilities? 5, is the entity providing substantial services that are essential functions of the real estate settlement service for which it receives a fee? And 6, does the entity perform all the substantial services itself, or does it contract out part of the work? A, if it does contract out some of the essential functions, does it contract with an independent third party? If it contracts out to an affiliate party, does it provide any functions that are of value to the settlement process? And B, if the entity contracts out work to another party, does the party performing the work receive a payment that bears a reasonable relationship to the value of goods or services received? 7th, is the entity actively competing in the marketplace for business? And 8, is the entity sending business exclusively to one of the settlement service providers that created it, or does it send business to a number of entities? Now I can go into title companies. A seller may not condition the sale of property that will be purchased on the buyer's purchase